In the final weeks of this year, something unexpected has been unfolding in the global currency markets. While most investors have been distracted by stock rallies, crypto volatility, and geopolitical noise, the British pound has been quietly but decisively moving higher. Levels that many analysts had already dismissed are now back in play, and at the same time, the US dollar, once seen as invincible, is beginning to show visible signs of weakness. This has led to one increasingly serious question being asked across trading desks and macro research rooms alike. Is the British pound on track to reach 1.36 against the dollar in 2026, or is this just another short-lived rally destined to fade? To answer that, we need to understand what's actually driving this move, because currency markets are never random, and this shift is rooted in deeper forces that have been building for months. At first glance, the pound's strength seems counterintuitive. The UK economy is not experiencing a boom, growth remains moderate, consumer demand is fragile, and the Bank of England has already begun cutting interest rates. Traditionally, rate cuts weaken a currency, not strengthen it. But foreign exchange markets do not react to headlines in isolation. They react to expectations, relative policy positioning, and long-term capital flows. The reason the pound is rising is not because the UK is suddenly strong, but because the relative outlook between the UK and the United States has begun to change in a meaningful way. For most of the past 2 years, the dollar benefited from aggressive Federal Reserve tightening, higher yields, and global risk aversion. That advantage is now eroding. The Federal Reserve is approaching the end of its tightening cycle, and markets are increasingly pricing in rate cuts over the next year. At the same time, U.S. fiscal deficits are expanding at an alarming pace. Debt issuance continues to surge, and foreign demand for U.S. treasuries is no longer as automatic as it once was. This combination has started to undermine the structural support that held the dollar up for so long. When the dollar weakens broadly, currencies like the pound don't need to be strong in absolute terms to rise. They simply need to be less weak by comparison. That is exactly what we are seeing now. Meanwhile, the Bank of England's rate cuts have been cautious and measured. The messaging from policymakers has emphasized restraint rather than urgency. Inflation in the UK has cooled faster than many expected, but it remains above target, and wage growth is still elevated. This has forced the Bank of England into a slow and deliberate easing cycle, which markets interpret as relatively hawkish compared to the Federal Reserve's trajectory. In currency markets, it is not the level of rates that matters most, but the direction and speed of change. Right now, traders see the Fed moving toward easier policy faster than the Bank of England, and that divergence is helping to support the pound. Another important factor is positioning. For much of the past decade, the pound has been one of the most underloved major currencies. Brexit uncertainty, political instability, and economic underperformance led global investors to consistently underweight UK assets. As a result, speculative positioning in GBP has often been skewed to the downside. When sentiment shifts even slightly, those positions can unwind quickly, creating sharp upward moves. What we are witnessing now is not euphoric buying, but a steady rebalancing as investors reassess just how pessimistic they really need to be about the UK. Looking back historically, periods of dollar weakness have often coincided with meaningful pound rallies. In the early 2000s, during a prolonged dollar downtrend driven by deficits and loose monetary policy, GBP/USD climbed steadily for several years. While today's environment is different, the underlying principle remains the same. When the dollar loses its yield and safe haven advantage, capital begins to rotate elsewhere. The pound does not need to become the world's favorite currency, it only needs to benefit from that rotation. Of course, reaching 1.36 is not guaranteed, and it will not happen in a straight line. There will be pullbacks, volatility, and moments where the narrative shifts. Much depends on how aggressively the Federal Reserve cuts rates, how resilient the U.S. economy proves to be, and whether inflation reaccelerates on either side of the Atlantic. A renewed surge in global risk aversion could temporarily support the dollar again, while a sharp slowdown in the UK could cap the pound's gains. But when we zoom out and look at the broader trend, the path toward higher GBP levels in 2026 is no longer unrealistic. Technical structure also supports this view. The pound has broken above several long-term resistance zones that previously capped rallies. These breakouts suggest that the market is transitioning from a defensive posture into a more neutral or even constructive one. Long-term moving averages are flattening, momentum indicators are stabilizing, and price action is becoming less reactive and more directional. These are not the characteristics of a fleeting spike. They are signs of a broader shift in sentiment. Ultimately, the question is not whether the pound deserves to be stronger in absolute sense, but whether the dollar can continue to dominate in a world of slowing U.S. growth, rising debt burdens, and converging interest rate differentials. If the answer is no, then currencies like the pound stand to benefit by default. A move toward 1.36 in 2026 would not require extraordinary UK performance. It would simply reflect a normalization of global currency dynamics after years of dollar exceptionalism. So, as we move into the next phase of the cycle, the pound's rally should not be dismissed as a fluke. It is the product of shifting expectations, policy divergence, and long-term positioning unwinds. Whether GBP ultimately reaches 1.36 will depend on how these forces evolve, but one thing is clear: the era of effortless dollar dominance is being questioned, and the pound is quietly taking advantage of that uncertainty. If you want to stay ahead of these macro shifts, understand the real drivers behind currency moves, and see where markets may be headed before the headlines catch up, make sure you stay subscribed. The next phase of this story is already unfolding, and it may define the currency landscape of 2026.